In today's clip, I want to answer a really simple question as to what type of home mortgage is most advantageous for what type of personality, especially in context of wanting to get to FIRE, financial independence, retire early, of course. Yeah, XenPuck here. Man, oh man, I love easy questions that I see on the internet, especially when it's one that almost all financially independent households will reckon with, at least in the USA, right? So this one has to do with how we acquire housing, presumably for primary residence, but honestly, it doesn't have to be, right? I say this because in this country, most people who are rich or wealthy or whatever you want to call it do own their own homes. At least usually their primary residence, if not more. This isn't a requirement, but it's just what statistics show, right? Not too surprising because, well, very, very few people, especially really, truly rich people, are actual nomads that never stay in the same physical location more than a few months at a time, right? So now that we've established that people who are well off usually do own a home, we come to this question. Should you get a mortgage? And if so, would a 15 or 30-year mortgage be the more, preferable type, right? So number one, first, I'm going to immediately remove the first part of the question, which is, should you get a mortgage at all? Well, this usually just isn't much of a question because buying a house with cash is simply not feasible for the vast majority of the population, right? And I could honestly also argue that even if you could afford something entirely in cash, in terms of real estate, right? You should only do that if the entire cash pile that you're putting down is less than 20% of your entire net worth, or possibly even lower, ideally like 10% or less, right? The reason for this is simple. Sure, it's nice to not have debt, but all the cash you put down in exchange for real estate equity will be stuck in the real estate, right? It's hard to use that equity than cash on hand. Now, it's not impossible to tap into your home equity, just, well, harder, right? So let's ignore the no mortgage at all cases because it applies to basically way fewer people. Now, if you're thinking about buying investment properties, my point remains, right? It's almost never a good idea to pay cash unless it's a very, very small amount relative to your net worth, right? Because frankly, your cash can be out to be put to better use elsewhere. Now, point number two, the 15-year mortgage. Well, this is the one that Dave Ramsey would suggest, right? And in general, I think his methods are okay, like adequate, especially for financial beginners, okay? Now, I understand why he would suggest a 15 instead of a 30-year mortgage, right, which is the most common type. 15-year mortgages equals less interest in the long run because, well, the duration of your loan is a lot shorter, which means you're less of a risk to the bank who lent you money, which also implies that your interest rate itself will be lower, right? And to compensate for that, your per month payment is going to be somewhat higher. Not quite double, but definitely higher than a 30-year mortgage payment per month. Since I look at that mortgage as essentially a forced savings plan, having a larger recurring payment for a shorter amount of time basically forces most people to save more of their income if they don't want to lose their house. This is why the 15-year is perfect for financial beginners because it takes away from them a degree of choice. Now, people usually think of choice as a good thing to have, right? Philosophically, I agree that they are good things to have. But I think the majority of the population are just not very bright, right? Most people are kind of dumb. So when given too many choices, I'm sure you can think of a personal example from a neighbor or a friend or a family member, right? Where people chose very poorly as to their personal financial futures, right? In terms of decision making. So because of that, Ramsey's absolutely right. Okay, Dave Ramsey is right. If you remotely fear that you lack mental discipline to save, then perhaps a 15-year mortgage is this thing for you because it's either pay this bill consistently or you'd lose all the payments that you've put in and your house. Okay, most people will tend to prioritize their house payment over any and all other bills. So in that sense, the forced savings plans that's larger, i.e. the 15-year mortgage, will help people get more equity in their homes and at a faster rate, right? And possibly more consistently because it's consistently a bill that you have to pay, right? But now we're getting to point number three, the star of the show, the 30-year mortgage, the good old standby, the one most people already use anyway. Surely this can't be the expert pick for FIRE purposes. Well, actually it is, and I'll explain why, right? If you use a 30-year mortgage as is, right, well, you will end up paying a lot more interest in the 15-year. You will also, be paying a higher interest rate right from the start. All this is true. In exchange, the only positive is that your monthly payment is lower. Plus, also, I would mention again, this is what most people do anyway. So why is this the better choice, in my opinion, right? It's better because you do not have to be forced into using your money only for your home equity purposes, right? If you don't want to, you gain flexibility. Maybe invest the difference in the stock market. Maybe invest the difference into optimizing your income at your main job, or even creating other income sources via a side hustle, or whatever you want, really. Or maybe you just really hate the idea of debt. You can make additional payments towards your home equity still, even if you do have a 30-year mortgage, right? The point is, you're still forced into a savings plan because you have a mortgage. It's just a smaller one. Now, the way that I'm talking about the 30-year-old doesn't work and doesn't make any sense if you're not already approaching expert level in terms of mental discipline, right, on the subject of financial independence. What I mean is that if the money that you save monthly from a 15-year mortgage to a 30-year mortgage that you now get to keep in your pocket, if that's going to be wasted on non-asset producing or income producing type of spending, then a 30-year mortgage is not for you, okay? Honestly, I personally have had multiple mortgages already in my life, and it has never taken me 30 years to pay it back, not even 10 years, okay? Nor will that ever happen in my personal case, right? So I like the 30-year mortgage because of the lower payment, because that means in the meantime, I have more cash to maximize my own earning potential with. This is why taking a lower payment is the expert move, right? Maximizing my earnings is what allows me to pay off mortgages, my personal mortgages, much more quickly. Not even in 15, much less than 15, right? I do not need a forced savings plan, as I already have saved a significant percentage of my income at any given moment in my career, right? So if you're like me, or at least want to be like me, then the 30-year mortgage, with the caveat of using the saving as in cash to make more money, is the best way to go, at least for financial independence purposes, okay? No doubt on that. Now, in the end, if you just want steady and boring, then it'll just take longer to get to financial independence. And that's totally fine, right? I'm not advocating that you save money on a longer-term mortgage to go gamble it away in a casino or even on crypto, right? But there's plenty you can do in the span of a decade to increase your returns by a lot more than you can save in interest, right? Now, don't fall into the common trap of looking at the interest savings between, a 15 versus a 30-year mortgage, right? Now, you can go online right now, go Google one of these calculators that compares 15 to 30-year mortgages in terms of how much interest you'd save, right? Now, for an average medium-priced house in the U.S., it might show over the course of the duration of the mortgages, there's like something like a $150K worth of interest difference, right? So, wow, that sounds awful, doesn't it? I'm here to tell you that it doesn't sound that off, though. You know why? Because it's $150K over the course of 30 years. That would only average out to be $5K a year that you're paying extra in order to have your house, okay? My God, if you're a person that remotely wants to get to financial independence and want to retire from not have a boss, then I would hope that you better believe that you can increase your income on average by at least $5K a year, okay? That is not that much money, right? Especially over a few decades, right? So don't get trapped into that kind of, starving minimalist mentality in terms of earning versus spending, right? Money is always cheaper in the long run anyway. So take the longer mortgage and make more money, ideally much more money, and then you have the personal freedom to do with that what you will. Heck, do what I did, right? Pay the 30-year off entirely, multiple times if that's what you want, right? Because it would be your choice, not a choice that a bank is forcing on you, all right? Anyway, comment, like, and subscribe and all that jazz. Cheers. Till next time.